Okay, well, today we're going to be testing out my new webcam here. It makes me look a little bit bigger than usual, but it'll work for now. So today we're going to be comparing Amazon, Google, and Meta. These three stocks are all down pretty big, and they all are big tech stocks. And so if we take a look at Amazon here, we can see that Amazon is down 47% on the year, a pretty big downward move. And these stocks are trading at valuations that are a lot cheaper than where they normally trade at. So we're going to compare them and see which ones are better in what categories and which ones would be best for you to invest in. So I own Amazon and I own Meta. I have pretty big positions for me in both of those. And then Google I've owned in the past. I actually sold Google right before we had this market crash. I sold my Google for a nice profit, and now I really want to buy back in, and so that's where I sit with these different stocks. But Amazon just dropped below it a $1 trillion market cap, and its share change year over year is 0%, which means same amount of shares in the market as there was last year. So nothing too crazy there. The number of users they have, subscribers, is 300 million. Their PE ratio is 56, which may seem high. For most stocks it is, but when you compare it to where they trade on average, we see that it's a 78. So Amazon just in general trades higher. And if you look at their margins here, their average profit margin is only 4%. I believe on the low end it was 1%, and on the high end it was 7%. So just in general, like they do over $100 billion of revenue in a given year, but they're only actually profiting, $2 billion, $4 billion, maybe $6 billion. So it's something like that. So they're not a very profitable business. They just have huge scale and huge reach, and that's pretty much how they operate. But if we look at their revenue growth, we can see they grew revenue. They're expected to grow revenue 9% this year, which is pretty good. This is kind of a challenging year for a lot of companies, so 9% is not bad. Then we look at their average return on invested capital. This is 12%. Also not the greatest number. There's definitely a lot of companies that have higher return on capital numbers, but 12% is not bad. Some companies out there only have 5%, 7%. So 12% is okay. If you compare it to Meta and Google, you can see it's not quite as high as theirs. But again, Amazon, their business model is a little bit different. They've kind of made it to like the big leagues by not having a huge profitable business. So a lot of these other companies, Apple, Google, Meta, Netflix, whatever, these huge companies, most of the time they're going to have higher profit margins, higher return on invested capital. And Amazon kind of did the opposite, where Amazon has incredibly large amounts of volume, but their margin, they have very slim margins, but that's just the way they work. If we look at their balance sheet, their ratio for assets to liabilities is 1.5 to 1. That's good. That's not amazing or anything, especially if you compare it to Meta and Google, but still 1.5 to 1 is not bad. That's still a healthy spot. If we look at Meta here, this one has come down the most. If we look at the past year for Meta, we can see that it's down 50% in the last 5 years, which is awful, but 73% in the last year. So this one has definitely suffered the most. And it's kind of for, I don't want to say good reason, but it's the numbers show it being, I think they have the most amount of things to deal with, more so than these other companies. The market cap has come down now to $244 billion. I believe this was a $700 billion company like a year ago, and now we're only down to 244 billion. The share change is healthy. Looks like they're buying back lots of shares. I forgot the exact number. I think in my video I made on Meta a couple weeks ago, I think I talked about the exact number, but the share change is down 6%, so that's pretty good. That means they're buying back shares. I think it's definitely in the billions. It's billions and billions of dollars worth that they're investing back into the stock. The number of users for Meta is 3.7 billion. So they own Facebook, Instagram, Messenger, WhatsApp, and the Oculus. The Oculus is their fastest growing segment, but Facebook and Instagram, I think, out of all their platforms, they grew number of users by 4%. 3.7 billion people is almost half the planet, so not too bad there. Their PE ratio is 12 now, and this is for 2023 numbers. So 2022 numbers are expected to be a little bit worse, pretty much for all these companies. The numbers are expected to drop a little bit for this year, especially for Meta. Then for 2023, it's supposed to get a little bit better, I think. But Meta is, in this case, Meta is one that is investing in their most recent earnings report. I think they said between 80 to 100 billion dollars for this year and for next year. They're investing into AI and they're investing into the metaverse. I think AI is probably a more like surefire bet on, like a more surefire investment. I think it's a safer one. It's one that looks more obvious to be a smart investment. The metaverse can go either way. I think the metaverse, we're not there yet to where we don't know 100% what it's going to look like, how profitable it's going to be. I mean, we know that the opportunity is huge. You know, that's probably $1 trillion opportunity. If it turns out to be everything that they say it's going to be, and it's, you know, involved in so many things around the world, then Meta already has half the planet using their services. So they're in a great position to you know, take advantage of that opportunity and make a bunch of money. And there's a good chance they do pull it off. You know, 5 years from now, Meta could be a multi-trillion-dollar company that is making, you know, $100 billion a year plus just from the metaverse alone. So we'll have to see what happens there. Once again, that's a bit of a wild card, but we'll see. But anyways, PE ratio is a 12 on this stock, and the average PE ratio for the stock is a 24. So it's trading at half the valuation it normally, not half the valuation, half of the PE it normally trades at. So this is pretty much the cheapest you're going to get it. It's probably never going to be this anywhere near $240 billion again. I firmly believe Meta will be back to $1 trillion of a valuation within a couple of years. Average profit margin for this company is 29%, higher than both Amazon and Google. And again, their numbers are expected to drop. Their revenue growth for this year is expected to be 1% lower than where it was last year. And remember, Meta makes most of their money from companies paying to advertise on their platforms. So there's that. If we're going into a recession next year, let's say we're in a recession, and let's say companies are firing people. I mean, companies are firing people. They're pausing their hiring for a couple months, and they're also trying to cut back on costs. I've heard this from lots of different people in lots of different industries that work in lots of different positions at lots of different companies. So that is something that's going on in the background, and therefore that's going to impact their financials. But their return on invested capital is 23%, and that's pretty strong. Their balance sheet looks good too. We have a 3.2 to 1 ratio for assets to liabilities. And then the other thing affecting Meta is, of course, other platforms taking away their attention, right? So the way they make their money is by people spending money to advertise. That's the main way. By the way, the Oculuses are, I think the Oculuses are selling great. I think those are going to continue to grow, and that's going to bring in a lot of money for them. But you have things like TikTok, right? And a lot of people say TikTok is taking away the attention off of their platforms, which I think is true to some degree. I think TikTok has definitely put a dent in their business model and in the amount of people spending time on their platforms. That's definitely true. And that's why we see Facebook come out and try to replicate these other platforms, like how they replicated Snapchat with the stories. When Snapchat had that, they brought stories onto Instagram and Facebook. And they did it pretty successfully, right? There's still people using those platforms, and there's still people using those features. Now they're trying to do the same thing against TikTok by creating Instagram Reels, and they have Reels on Facebook. So that is what is hot right now. That is what people are spending their time doing, scrolling through short, under 1 minute videos on these platforms. But the other thing TikTok has as an advantage is they have AI integrated into their platform, and that makes their algorithm super strong. That is why Meta is investing all those billions of dollars into that, both the metaverse and AI, to kind of combat that and match, because right now TikTok's algorithm is probably a lot better than what Meta can do with Instagram or Facebook. So that's why Meta has some catching up to do. That's true. The other piece here is that Meta is a company that, if you compare it to other tech companies like this, whether it's Google or Apple, Meta is they rely on a company like Apple or Google who creates the devices, right? Meta is just that's why they're just starting to get into the hardware business instead of just the software business, because the software business is great, but when you have companies like Apple and Google who build the hardware where that software is on, and those big companies are trying to compete with you, then they're going to make it as hard as they can for you to succeed. And that's what we saw the last year or two with how Apple and Google treated Meta, right? So that hurt their business model. And that's why, but years ago, Mark Zuckerberg was already starting to become interested in building out hardware, and that's where this Oculus idea came from. So he's already a little bit ahead of the game. Another way to look at this is not just the business models, but paying attention to the people at the actual people at the company, who runs the company, who the executives are. That is another thing to pay attention to, because you don't want to bet against the people who know what they're doing. There's like, it's just like in sports, right? Like, you wouldn't want to bet if it's let's say it's 1995. You're not going to want to bet against Michael Jordan, right? You're not going to want to do that. It's kind of the same thing here. Some of these executives, like Mark Zuckerberg, for example, they have a strong track record of years and years of succeeding and with getting experience competing against these other companies. So that's another reason why I wouldn't want to bet against Mark Zuckerberg. I would want to be on his side. I feel the same way about Elon Musk or Jeff Bezos. These other guys, I wouldn't want to be competing against them or betting against them. So I'm going to invest in them, so that way I can succeed with them. If we go to Google, Google has the highest market cap here with $1.1 trillion. The share change is down 2% year over year. That's good. That's pretty healthy. They have the most amount of users at 4.3 billion users. That's more than half the population in the entire world. Their P ratio for their earnings next year is a 16. That is very cheap for Google. If we look at where they normally trade, it's a 26 PE ratio for Google. So you're getting Google very cheap. You're getting Meta at half of where it normally trades based off of its earnings. And Amazon is also significantly lower than where it normally trades. Then we have Google here with average profit margin of 22%. And that's also very strong. They're expected to grow revenue 10% this year, which is also very good. And then return on invested capital, they have the highest with 24%. And they also have the best balance sheet with 3.4 times the number of assets than liabilities. So Google wins here in a lot of categories. The interesting thing, though, is that Meta has the largest profit margin and the cheapest valuation. Meta has a 29% profit margin and only a 12 price to earnings ratio. So that's pretty good there. But I'm really interested in adding Google to my portfolio. But really, I think you're in a pretty safe position investing in all three of these. So yeah, we'll have to see what happens. But I think all three of these can be good investments. I'm curious, which stocks are you guys interested in the most? Comment down below. Tell me which one are you investing in and which one do you think has the best future ahead of it. Thank you for watching, and I will see you in the next video.